The stock market is one of the primary sources of revenues used by individuals or corporations to run or expand their business entities. Also, the stock market offers a long-term investment opportunity to individuals and business entities, because it provides liquidity that enables investors to quickly trade their securities. As compared to other investment opportunities, although investing in the stock market can be a risky undertaking, the stock market offers a dependable performance of a diversified portfolio of stocks. One primary advantage of stock trading is it's associated with superior long-term outcomes. Although it is very hard sometimes to predict the market price trends over a long time, for example, more than one trading quarter, stock market investments have high returns that can be in form of dividends or capital gains, as compared to bond and certificate of deposits. This is made better by the fact that the amount of loss from stock procured with cash is only limited to the aggregate sum of the early investment. This makes it better as compared to most leveraged business dealings, where the nature of losses accruing from such undertakings can exceed the originally invested amounts. A second advantage of investing in the stock market is that, through owning stocks, individuals are guaranteed a direct means of participating in the building of their nation's economy. This can be very beneficial to an individual and, because of the numerous gains associated with being key investors in a nation's economy. The third advantage of this form of investment is that it offers individuals long-term investment opportunities that are easy to access and exist, more so as concerns saving for retirement. Although it is very hard for one to predict correctly future changes of stock prices, the more the time individuals participate in stock trading, the more the insights they will learn on how the stock market operates and how to conduct their trading to avoid losses. Further, stocks protect the passive stockholders' liability beyond their reserves and organizations. On the other hand, because of the liquid nature of most stocks, their trading is easy, more in times of extreme price fluctuations. This offers individuals a chance to trade their stocks, depending on the prevailing market conditions. Royal Scandia Life Assurance Limited. Although stock trading has numerous advantages, proper use of appropriate economic policies can help to mitigate their effects. They include, to start with, it is a very risky adventure, because of the volatility of market prices. Hence, unless individuals make correct predication before trading in their stocks, likelihoods of entities suffering great losses are high, as most factors that cause these fluctuations cannot be controlled by an investor. Secondly, although stock markets offer a good retirement investment opportunity, it is not a stable form of investment for old age. Hence, it is important for individuals to transfer their funds to safer solid investment, to avoid frustrations after retirement. The third disadvantage of this form of investment is that it has many associate costs, right from the initial minimum deposits to transaction levies charged by brokerage firms. These charges may reduce the revenues earned from an investment, hence, to a larger extent limiting the amount of earnings from stock trading. Finally, investing in the stock market can be a very time-consuming venture, as it requires frequent checking of one's level of achievement. Further, the process of researching for the most suitable portfolio can need a lot of time.
For most households,
it being the primary determinant
is
of the
greatest
level of
source of
achievement
wealth
of an
and a major
individual in the
source of
stock market. Risk. Does this labor income risk affect the financial risks that households take as theory suggests? The theoretical impact of labor income risk on household financial risks is not immediately apparent in U.S. households. I show that employment characteristics associated with greater labor income risk are found among households that take greater leverage and allocate a greater share of financial assets to stocks. To understand this puzzle, I investigate how 4 forms of labor income risk are distributed across households, paying particular attention to the role of risk preferences. First, I model labor income dynamics to identify these 4 forms of labor income risk. and relate these risks to worker demographics and employment characteristics. I estimate. This model using 4 decades of data from the panel study of income dynamics, PSID. In the second stage of my analysis, I used a survey of consumer finances, SCF, to study how these demographics and employment characteristics further relate to financial risks and risk preferences. The labor income risks I study include the unconditional variance of permanent 1. Labor income, permanent income variance, the probability of becoming unemployed, as a proxy for disaster risk, the movement of permanent labor income level and unexpected stock returns, permanent income cyclicality, and the movement of permanent labor income variance and unexpected stock returns, variance cyclicality. I find economically and statistically significant variation across workers in each of these risks. According to theory, exposure to these 4 labor income risks should affect the financial risks that households take. For example, Visera, 2001, shows that optimal stock allocations for workers with power utility fall in response to greater permanent income variance and permanent income cyclicality. Jacobson et al., 1993, study the economic costliness of job loss, the likelihood of which can produce large changes in optimal portfolio allocations to risky assets, Bremis and Kuzin 2011. Mankiw, 1986, and Constantinides and Duffy, 1996. Demonstrate the importance of variance cyclicality in asset pricing, with Lynch and Tan. 2011, demonstrating implications for life cycle variation in portfolio choice. Labor income risks impact the optimal choice of household financial risks through 2 channels. These channels create the distinction between unconditional and cyclical risks. The first channel by which labor income risk operates is through the effective risk tolerance of the household. Effective risk tolerance is the willingness of the household to take an additional risk, such as an investment in a volatile unhedged asset or by increasing leverage. Theory suggests that an investor's effective risk tolerance declines as the amount of uninsurable risk they face increases. The marginal costs of taking a risk increases with the total amount of risk. 1. I refer to labor income risks that decrease household effective risk tolerance by increasing background risk as unconditional labor income risks. The 2 unconditional labor income risks I measure are permanent labor income variance and the probability of becoming unemployed, which is a feasible measure of disaster risk. The second channel by which labor income risk operates on optimal household stock allocations is through the desirability of stocks as a hedge, the covariance of the marginal